Okay, this is a lecture about corporate finance analysis. I'm going to try to make this more professional. I got a comment that I wasn't professional enough in these videos. So, here's really why I'm doing it. Somebody asked me a question in my class, and I need to respond to it. And the question is about reconciling the IRR and the ROI, or the project IRR and the ROIC, or the equity IRR and the ROE. And I said, it's kind of the same over time. It all stabilizes, but that's, it's just not right. It's just not correct. So I'm putting together a whole kind of lecture about corporate finance analysis, and I'm not going to get anywhere close to finishing. What I hope to do is get to this stage where we can reconcile the ROIC and the project IRR. I might not even get to that stage. And I'm going to go through some difficulties, a little bit of an introduction, some difficulties, the value drivers, the RO, the return, and the cost of capital and all that stuff, and then eventually get into issues like multiples, cost of capital, DCF models, terminal values, whack issues with beta and taxes. A lot of this stuff I've talked about other places, but I'm trying to put it together because I've got another class coming up in this, and I'm a little nervous about it. All right, as usual, if from the modeling perspective, and this is going to be more about, at least this one is a little bit more about theory and less about modeling, I'm going to try to keep things flexible and structured. Those two things conflict with one another. This is my religious photo about being religious about these things. Accurate or appropriate, I don't know which is the right one. Transparent, making things simple, making things structured, and making things flexible. They're hard to do in your life. When we make the models, I'm just trying to keep things the laziest possible way I can do them. The only functions we're going to use are index, lookup, a little bit of SUMIF and eDates and mins and max, but that's it. None of this overdoing the functions, maybe one little offset. And as usual, I hope you have kind of looked at the generic macros in the read PDF, and I've got a little thing on this. I put this in my project finance analysis too. A project is like an individual business that might go bankrupt. A city is like a corporation. A family is like a corporation. A person's like a company. But here's the big difference. And I redid this one. In corporate finance, we do things over the life of the project because we have no terminal value, because we have no end point. We don't die in corporations, in cities, in families. You don't know when to stop, and you have to put some kind of terminal value. That makes it a pain. In project finance, we use the equity IRR, and people, you can kind of ask what the equity IRR is. People overstate it, and there's a whole lot of blurry, and you can kind of compute any IRR you want, but WACC is even more of a subjective. It's like a little smoke coming out of some kind of black box. Okay, if we want the real economic value of the asset, we can use IRR, and here we're supposed to use ROE and ROIC. But they're a whole lot more subjective than the IRR. For credit analysis, we do DSCRs and everything. In credit analysis, we have to basically make a judgment whether this company can refinance itself eventually, or whether people will lose trust in the balance sheet. It's a lot harder, really. Okay, and everything comes from just the cash flow in project finance, and then we have to use multiples, which can change over time. You've got to understand why they change and all that. It's hard. Okay, so with some project finance ideas are good in corporate finance, like understanding individual projects and what kind of IRR individual projects are making, and if it's reasonable, is a big deal. And deciphering that is really hard. Understanding how, rate of return changes. You look at project finance and you say, the rate of return increases over time. And that can happen in projects. Now, the other thing in project finance, risk changes all the time. In corporate finance, we say it doesn't because we have this WACC mystery. But we should understand for some things like synergies and other things and companies aging, maybe the risk does really change. Okay, and the IRR is the minimum calculation. Now, this is my big slide. I spent a lot of time finding a magic potion picture. There are so many things. I used to really believe in this corporate finance stuff, and now I think it's just it really is a bunch of magic potion. This expected market risk premium that people say is such a big thing. If investors always have to earn something like 6%, they get really, really rich because that's their expected return, and the rest of the economy goes down. And let's keep going. Adjustments to the WACC for depreciation and for the tax deduction on the interest and beta. Who knows what that is? And the worst is this formula, this very famous formula that I've got a phone call, just a minute. I'm gonna pause. Okay, back. At the end of the day, corporate finance is so much more undefined, and you're kind of putting some trust in things and pretending that any of this is anywhere near scientific, I think, is a real dangerous thing. I've come kind of around and around on this stuff for so long. Here's an example. This is a real transaction. I clipped a couple of cost of capital things from a real transaction. One, the top is a buy side of a merger, and they said, WACC is 5.9. The bottom is the sell side. It should have been the other way. And I talk about this, a myriad of adjustments for political risk, liquidity, mean reversion, and all that stuff. You change the WACC like this, and here I should be looking at this. If the growth is 1%, you get 55 versus 30, 64 versus 30. Here, in this case, the WACC changes it from 20 to 41, 34 to 80. Is that? No, 60, 50, sorry. But it's still enormous changes for this. And here, somebody told me about this. Oh, great. Oh, my God. This wonderful website, WACC Expert. I said, okay, let's just plug in food in the U.S. They give 6.19 to 11.86. What a crazy thing. So let's talk about some more specific things as an introduction here. Let's say a company has some fluctuations, but it's not growing not too much. It grows about the same rate. The industry has some nice multiples. They stay pretty constant over time. Maybe they change a little bit over time as the market goes up and down. And they're pretty stable across different things. And here I'm going to talk about this McKinsey book that it used to be my guide for corporate finance. Now I think it's a disaster. I can't say anything else. But they use nice, smooth companies. These companies all invest a lot. UPS, FedEx, Heineken, Disney, Walgreens, they all have a lot of investments. And if you have these, you just start by reading some financial data. We'll do some of this. Next, you take that financial data and you make some nice little assumptions and beautiful graphs out of it with the actual and forecast. You create nice pictures of the return on invested capital, and you can even apply this kind of multiple. And then this is something I did a long time ago, but it's kind of shows you got an assumption for sales growth and ROIC, and as long as the ROIC is kind of reasonable, you can look at your valuation and see if your valuation is consistent. If this ROIC is really high, you say, I don't know about that. That's in the in the Google Drive. So a lot of these featured models, unfortunately, in the Google Drive, I've got corporate models, featured models, and a lot of these featured models we made in various classes. We took all our financials, but a lot of them are pretty stable companies, not all of them. Okay. All right. And then let's talk about, I kind of talked about some mature companies, not too big write-offs, multiple similar investment, things like price to book ratios are pretty stable, return on assets is, you can look at the past and get some data. But now let's talk about the real world. Okay? Let's talk about software, where capital investment is maybe losing money for a few years. And then the balance sheets, they're affected by dramatic things like write-offs and restructurings. If you have an asset sale, you might have a big gain on the asset sale. That pushes your equity investment up and it pushes your return down. And those all things affect the return measurement. Multiples can change a whole lot over time and be completely different for different companies. And the value of the investment, I'm reading now, this is really bad. If it was really small in the past, that might have nothing to do, because when you go to new investments, you might have to buy a lot of companies and spend a lot on goodwill to get them. Okay? So, and what happens if I already talked about large write-offs. I'm repeating myself here. What about things when you have contracting businesses or law firms or something like that? What if your return on new investment is totally different than the one on the old investments? How do you even figure that out? What if you've grown really fast and you don't really think you know how long the company can grow, do you? Okay. And so here, let me just finish this kind of introduction up. How am I doing? I got to check. Okay. If we, these new economies, things were laughed at, and I did too. But maybe now, look, they're not so silly. Here's what McKinsey said. The extraordinarily high profits represented by the stock prices during the internet never materialized because there was no new economy. Okay, now, here is what I have done. I have gone to, and I have worked a lot on this for you, as if you care. But I hope that one or two people will look at this thing. It's called Comprehensive Stock Analysis. And I have you see my schedule, sucko schedule. And then, this is my classic one for the S&P 500, but there you can go and get all this stuff from either Yahoo, the Federal Reserve Economic Databases, Google. You can read commodity prices, compare them with stock prices. You can get indices or stock prices, get exchange rates. This should say exchange rates. And then kind of compare different different things to one another. So I'm going to show you what happened. I think, what happened to some of these internet companies. So here's a little thing. What you do is you press this little button and it reads all the kind of stocks you have. So if we look at this one, I might be unprofessional today. Okay, if we have, this has got all of the stuff, this horrible stuff, and I had to work on that a lot, frankly. It's got how to put together a URL. I'm not going through this anymore, but I just took two indices. And then once you put those two indices in, it says, okay, we can get that. Or maybe we don't want to put them in our list. So if we don't want to put them in the list, you just click off of it. Okay, and then it takes it out. Okay, and then I already showed you this one, and it shows you the IRR you make over time. Now, if you go to this video is eventually, it's going to be two videos. I didn't mean to do that. Okay, let's click on this and this. And if I want to then take and look at the IRR here, this IRR, how much you've made, and if I want to look at starting in, let's say, 1977, then what's your return would have been this. And you can, of course, stop at different years, too. So if you go from 1990 to 2017, but if you would go to 2009, probably wouldn't be a very pretty picture. Then it's 6% you would have made over that period. If you would have started in, let me see, 1998, you would have made 1%. So the IRR depends on the starting and ending dates. Okay, and the way you get an IRR from stock prices, just like anything else, you take the final value divided by the initial value, and you compute a compound rate of return. And the nice thing about Yahoo is they have this thing where they reinvest the dividends and adjust for stock splits. So then I included the DAX, and McKinsey says it's only U.S. companies that do well, but when you compute the DAX, you better, and the summary kind of page shows you how to do it, you better adjust it for the exchange rates. You better put a exchange rate adjustment in here, okay? And somewhere I've got this, I hope. Okay, and so let's compare. Now let's add the DAX. So you just click on this button, and then you get a new thing. Now it didn't start till 87, so if we start in 1988, okay, let's do that, and you can kind of compare the two, and you can look at the difference in the volatility and then the beta. The volatility is kind of, in this case, more relevant because the beta just probably depends on different timing or something. It should be more related, really, okay? And then we can go all the way down to 2017 and see what happens, okay? And the DAX is outperforming the S&P, even though the stocks have risen so much lately. And then you can, here's what they say about new internet. This is during the internet bubble, management's lost sight of ROIC. Well, they didn't make any invested capital. They forgot about the ratio. Oh no, they forgot about ROIC. Many executives threw out the fundamental ideas. This notion of the first mover, that's what people really call it. They say winner take all, first mover. Let companies and this made them naively think that you just have to get big fast. And but they got it wrong, because companies like Amazon had to make real investments in, and they paid for inventories and everything else. And it wasn't clear that anybody like Priceline or anybody had an unassailable comparative advantage. Well, let's look at this. So here's what I did. I started adding companies. I'm not going to go to the file anymore. And I added General Electric and Priceline. Priceline, oh, what a classic, horrible internet company. Then they did go down. They stayed down for a long time, and now they've recovered, and their IRR is higher than any the S&P 500 or the DAX or anybody else, and certainly higher than GE. Then you compare eBay. It's even more extreme. Look at that one. What's this thing? And then of course Amazon. The other graphs look like nothing when you put Amazon. All you do is click here. And then here's what really happened in the dot-com bubble. There was a big oversupply of telecom equipment, a gigantic oversupply. So here's the British Telecom, Sprint, U.S. Cellular, and all these. Here's what happened. They had all these spikes. Went way up from 1 in 2 years to 6 times. The value went up by 6 times and then came crashing down. Sometimes it's recovered a little, and here's the kind of IRRs you've made over time. Here's the volatility. The betas don't really mean nearly as much as the volatilities, at least. Maybe not. And here's some bankruptcies. The telecom had the highest bankruptcy. So I think the dot-com bubble that they're moaning about was a lot more about telecom. Maybe not. Okay. Now, I'm going to move, and I'm going to try to get past this second thing,
the second part, which is going through fundamental ideas, this idea that you have to have returns, growth, and cost of capital. There's no question that these are the main things. Here's a little graph on it. So I'm going to post these slides. I took this graph from God knows who, years and years ago. They say you have to get an economic advantage. You have to get people addicted to your products and have good management strategy. And then you get a high return on investment and you grow and you have a low risk, hopefully, and that's your valuation. Okay? Now, when I do this, the interaction between the return and the WACC is a real big deal. Okay, and here, I want to just talk to you about making an investment. And I always believed that this ROIC was just right, because if you don't make an investment, you don't get your life any better. If you don't make any CapEx, you don't get a EBITDA. If you don't buy a stock, how can you get dividends? Even if you gamble, you got to put some money down. But think about other companies, Uber. Their drivers have to make all the investments, and then they just pay them 20%. They make a little software, I guess. I don't know. Services. What about when these consulting companies offer their big services? I know they made an investment in their reputation. What about GE when it makes a service contract for its turbines? Or Siemens when they make a contract for a wind farm? What about construction contracts where you make a profit, for having a couple of tractors, but you have to make a profit because you're taking a lot of risk? You don't make an investment there. It's not always ROIC. Okay, now, here's what McKinsey says. The idea that return on invested capital is the only thing that drives value, okay, and you need to have cash flow to have value. And they used to have this economic value added, and that's getting into it. Now, if we want to see how this works, it's so easy. There are two equations you got to know. One is that the perpetuity is just the cash flow divided by the cost of capital, or just adjust it for growth, and then cost of capital minus growth. It's just integral calculus, that one. This one up here is just integral calculus. Second equation is our growth equation, which doesn't help at all, but when you put it around, then you figure out what the payout ratio. Growth is not driven by the retention rate and the payout ratio. Payout ratio is driven by whether you have growth. If you have a good growth, you're not going to pay any dividends. So you can just put those two together. Here's the value, is the dividends divided by the K plus G, but then get the dividend payout ratio, put the earnings, dividends is that, so you get the dividends up here, and you get that simple formula. And then you can just divide the earnings, and you get the PE ratio, and you can do even better. You can say, well, earnings are book value times the return on equity in the current time period. So then you substitute the earnings up here, and you get the value, and then you get the other kind of equation, ROE minus G divided by K minus G is the market to book or price to book ratio. Okay, if the growth rate is 0, then it doesn't matter, the return doesn't matter, because if you have 1 minus G, which is 0, or ROE, that all falls out. Okay, if the growth rate changes, it can make a really big difference. Here's what McKinsey says. You might as go so far as to say this formula represents all there is in valuation. Everything else is just detail, but it doesn't really work very well. I've talked about it a couple times. If things are not constant, if there's inflation, if new returns are different than older returns. So I started, but I want to show you this because I'm making this video about returns and IRRs eventually. Really, that's what I'm going to talk about in the next, it's going to be in a subsequent video. Okay. I want to show you kind of how to use this formula. And there's a little spreadsheet. And on this spreadsheet, I made a data table. And I said, okay, let's put some growth, inflation, and all that in. Okay, and I better pause. Okay, if you go into the Google Drive, Advanced Valuation Issues, of course, I have to update this. And then if you go to the one called value driver formula, and then there's a one called value driver sensitivity. That's all this one is. Okay. And here's what I did. I used our fundamental value driver formula, actually, if you take inflation out. And then I did one of these things, and I'm not going to do it again. We put some range names in here, and then made a data table where you don't have anything in the middle. That's the big deal, because if you don't have anything in the middle, you just make a graph. So you can look at the the whole macro to make a data table, but you just, let's change something, okay? Let me see, I changed this, I should have put it at the top. This is ROIC, which is the same as ROE for now, if we assume it's all equity. And let's put a different cost of capital in, maybe. Ooh, we better put 7%, because the growth right now is really big. Okay, and then you just run the table, and then once you run the table, you make a little graph of the table. So right now it's just filling in the table. Okay, and then when you make the graph, the good news is you just press, of course, the F11 key, and then you go and you say, okay, well, let's, fine, I'll make it a line graph. And you can make it either one. You can switch the row and the columns to make it either one. And here's the implication of all that. Okay, so when we change these are, there's a whole lot of interrelationship. When I say right now ROE and ROIC, it's the same thing. And if we change the return, it's very, very much more sensitive to the growth rate than if you don't change the return. If you don't change the return, you just have a kind of your current return, whatever it is, you just divide that by the cost of capital, because the growth rate, the return falls out of the equation, like I just told you. But if you do it this way, where you put the growth at the bottom and this is the value at the same time, and that data table is so much better than the old data tables because you can graph it. And you can't do it because can't do it because of that little thing in the middle. And then you can see, well, if we have high growth rates, it's extremely sensitive to the case where we have a really low return or really high. But if our return equals the cost of capital, nothing matters. So there's that interaction. You can't say growth matters or return matters. It's just mathematics. Now, if you put inflation in here, I've got a whole nother video, and I'm not going through all the details right now of this whole inflation stuff. But if you put inflation, then what happens is this is the one without inflation. With inflation, the kind of point at which the growth, and this got a 3% inflation, the point at which the growth doesn't matter is when at the inflation rate. Here, not here. Okay, that's the key. You get a different kind of answer, and you get a little more variability in the whole thing when you include inflation. And so this is this whole problem of inflation in the formula, and it doesn't work unless you recognize what's a real number and what's a nominal number and what's the real cost of capital and the nominal cost of capital. Okay, then it gets a little more interesting, because then now the real issue in all evaluation, and that's why ROIC and ROE is so important, is what happens when returns change. What happens when you think they're going to go down or you think they're going to go up. Now, here's the kind of classic silly thing that says at the end of the day, the return is equal to the cost of capital. Absurdity. And then you say, well, eventually we want to fade down, so we can use our interpolate lookup function here, and we think we're fraudulent by thinking we know what's going on in the recent things. So the next model has a low case and a base case, and we have different increases in ROIC or ROE. It doesn't matter. This is all equity at this point. And the cost of capital is we can vary that as well, and then we can look at this with different growth rates. So we have a high, low, and I want to look at the effect of the return going up and down versus the growth rate being different, or the starting ROE being different, which affects the value more. And again, the answer is not so clear. Now, what you do is, as soon as you get this, you say, okay, well, this was the high case, so we go from 1 to 5, and then we make our ROE go down, or in this case it goes up because we've got the high case, and then we make a little model, and this model is right here. Okay, I don't care about this thing anymore. Alt yes. So you go and you make your model. I put a true and false for different terminal switches, and then you okay, we better expand this. This is just a shift alternate right arrow to make those little things, okay? And the colors come from the generic macros. And then we have our Interpolate Lookup macro, which I just showed you here. I did a linear case of interpolation. And then we can get our valuation. Our valuation is just, we take the dividends, and we use the payout ratio function, which says 1 minus g over r, basically. So we get the payout ratio up here. Payout ratio is a function of the growth, not the other way around. We make our little model, and we get some dividends, and then we go and we have a terminal value here. We have a terminal value, and our terminal value uses that value to book ratio. So we can just take the opening book value and multiply it by our terminal period ROE. And then we get our NPV, and we can look at different cases, okay? Now, if you, so we can look at a different starting case and a sensitivity cases, and those sensitivity cases, now I proved that this whole terminal value business works by making a 400-year model, shift control R. That's all you have to do to make a 400-year model, okay? And then I put the sensitivity analysis together and made a tornado diagram, which you can get all these other videos about. So again, I'm not going to do it here, but I'm going to talk about the implications. And the implications are that if you, in this case, if I use a cost of capital of 8 and a terminal value of 5 years into the future, it's the ROE that matters, and then the starting ROE is in second place, and the growth is in third place. But then, if I make a much lower cost of capital, then the growth starts to matter, and the growth is up here, and we have more upside than downside with the growth, because the interaction that I talked about. But still, it's that change in the ROE. That's what you're really doing in one of these analyses. And then you can make the terminal period longer and keep the cost of capital the same, then the growth matters a little much more. And actually, this is a smaller number. You see, this just goes to 6, and this just goes to 6. So this is a smaller variation because it took longer time for the ROE to go up with our interpolate thing. And then if I change both, then the growth is up here. Still the ROE that's the big thing. Now, what happens if we use ROIC instead of ROE, if there's some debt in here? So we can't use the dividend payout ratio function. Now, I'm sorry, I just don't get this. They say G is ROIC times the investment. What's the investment investment rate? What's the investment rate? I don't know what it is. That's kind of like the dividend. It's like the retention rate. It's not an intuitive thing. But if you go here, if you say the free cash flow is EBITDA minus CapEx minus tax minus working capital, you can get that stated in terms of NOPAT. And then what you do is you say, well, the NOPAT, the invested capital is going to increase by the CapEx minus the depreciation plus the working capital plus other items. And what you need is some kind of formula for this stuff. So you first can take this one. This is what the working capital change is. Okay, and then you can get, for the growth, you can use this formula, depreciation rate times capex divided by depreciation, and you rearrange it and do some stuff, and you get that the capex to depreciation is a function of the growth rate. That's kind of like our dividend payout ratio. And then you can go through, and I spelled stabilize wrong, I'll fix that later, I guess. And you can kind of work through, and in that file that I just showed you, which is called Simple Value Driver, we can kind of get a stable net plant to depreciation ratio. You have to go through a whole, use a lookup function. I don't know if I used the index. I had to use the offset one time because you have to retire assets. And I've done this so many times, but you get a stable ratio of capex to depreciation, which depends on the growth rate. And the depreciation rate also is a function of all that. And then what you do after that is make a ROIC model. So instead of ROE, you put ROIC, WACC, tax rate. You have working capital, I put to NOPAT instead of EBITDA, and then you have the plant life and see what happens to the value when the plant life changes. And okay, the value it wasn't sensitive in this case to the plant life, but the EBITDA is. And eventually you just go through a plant balance calculation, the working capital balance calculation, and you get the NPV of the whole free cash flow, which is, okay, I'm going to finish this video. But this cash flow up here and this cash flow down here, we didn't have to do it all. It just works. That's all I can say is you just take the standard value driver formula. Now, here's why this whole thing is an introduction, because in the next video, I'm going to work through this IRR versus ROIC and show you that it's not exactly the same. Okay? And I think that's it.